All right, good afternoon. Thank you for everyone that is calling in today. Today we're going to use a Q&A, question and answer format to go through some kind of top of mind questions that we've received over the last several weeks with some market volatility. And when I say market volatility, I really mean the whole broad market between stocks and bonds. So we'll go through that today. I've got Bill, Jared, Brandon, and myself. We'll answer those questions. If you have any particular questions that you would like us to answer, please go ahead and put those in the Q&A feature. There's a Q&A button in the panel. Click on that and you can enter your question there, and we'll be sure to address those throughout the call. But without further ado, we will get started. We have a couple of slides in here that we're going to touch on. We're not going to go through a presentation, but we'll use them as reference as we go through the call. So we'll start off with, what we start most client meetings off with is discussing recent performance.
Yeah, I'll go ahead and take that. So what we're going to do is we're going to use this periodic table, which many of you are familiar with. We've used this in past conference calls and luncheons as well. Really like this as a way to demonstrate and show trends. As I was reminded one time by a client, like the most important thing of this entire periodic table is to show the black, which is the moderate benchmark, because it shows you the benefits of diversification, right? So the idea is that if you own a diversified portfolio of all of these investments, which you do, your portfolio return, overall return, is never going to be the worst. Of course, it's never going to be the best, but you can see that it tends to move up towards the top. The other thing I'll point out about this is we're showing the black box as a moderate benchmark. So this is just the combination of stocks and bonds. Actual portfolios include things like reinsurance and trend following, and you can see that those have done quite well this year. So actual performance of your portfolio is considerably better than the benchmark itself. We're not going to show that information, but if you go and look in your portal, you'll be able to see the comparison of the portfolio to the benchmark. And we're going to talk today about some of those reasons, but I already mentioned the first reason is that things that we own as diversifiers, which are not in the benchmark. So the red box is trend following. So those are strategies that basically simply kind of buy things that are going up and sell things that are going down. This year, that's been a fabulous strategy because commodities like oil have been going up and have been going up all year. And bonds, up until recently at least, have been going down. So you can see the bond return in the green minus 10%. So the trend followers have captured those returns and been able to generate positive returns in a year when just about everything else is down. And then, of course, reinsurance. We're not really into the period where the returns for reinsurance will be determined. That's more of the hurricane season, but so far this year they're up 3%, which compares very favorably to both stocks and bonds. Stocks have all done poorly this year. You can see the negative returns at the bottom of the column. So whether it's international stocks or US stocks, they're all down double digits. And probably the biggest surprise this year is bonds. So bond returns, remember, are a combination of the income that you receive from the bond plus the change in interest rates. And we're going to talk a little bit about today the fact that interest rates have gone up a lot, and that's resulted in a really dramatic slide in bonds. If I was to show you this periodic table for the last 40 years, this is the worst return that you would have seen. If interest rates go the other direction and they actually go down, then that bond return would be captured. And then finally, I just wanted to point out that if you look at the 5-year return, so this is the return over that last 5 years, the best has been US large stocks. But interestingly, once again, the diversifier that we own, trend following, is actually up second most, 9%, despite the fact that from 17, 18, 19, 20, trend following did okay, but in relative to the other asset classes didn't do as well. Any comments on that? Okay, so I have one other slide we could look at for recent performance. Been using this slide a while. I think it provides like some context to, like, instead of saying, hey, over the last 2 years, what was the return? It's called the path matters because the way that people react to markets and make investment decisions is based on the path. not necessarily just the overall return. So we're highlighting here, obviously, we're starting at the beginning of 2020, which was right before COVID. You can see the dramatic decline in stocks and bonds, honestly, and a global kind of balanced portfolio was down literally 20% in a month, right? And stocks were down about 35%. But what happened subsequent to that? And a lot of what we're going to talk about today is maybe a reflection of that huge run in stocks from the bottom of COVID back in early 2020, all the way up to the top, kind of around the beginning of this year. So we've seen a huge rally in stocks that certainly started to decline and roll over. We can see that bonds did okay post-COVID, but now are negative over this period. And a balanced global portfolio of stocks and bonds is only up since the beginning of 2020, about 5%. So we're getting close to essentially no return from COVID. So a lot of what we're going to talk about today is the result of government action and the impact of COVID and how that is then reflected in stocks and what that means for the future. So it's been a tough year, no doubt. I would point out, though, that you should expect stock market declines like we've seen, kind of roughly 20%. Once every about 3 years or so. It's not unexpected. We plan for it. We anticipate it. We position portfolios such that when stocks do decline like they have, that that they're going to suffer losses, but the losses are easily recoverable. And I think that the question now is kind of where do we go from here? Because if stocks fall 20 and then basically rebound, then essentially the year's going to look fine. It's just a question of where we go down. I think you had sent me a chart today that said the average decline over the past 30 years has been 14%. So that happens just about every year. On the other hand, I think it was just about 70, 80% of years are up. So the idea is stocks always typically decline in a year, but they ultimately end up. See if that plays out this year, but certainly it's been a difficult year, and the news is not very positive either. So I guess I'll
reiterate the point about the stocks being down. You mentioned about once every 3 years, and so to give you a sense, since 2008, counting 2008, the market has had intra-year declines of greater than 20%, about 6 times.
6 times.
Since 2008.
Pretty typical. Yeah.
So it's pretty typical. It's not out of the realm.
I guess this year the difference primarily is the fact that bonds are down also.
Yes.
Been the case historically that bonds have supported stocks, so maybe they go up when stocks go down or they stay flat. But as we'll discuss, inflation is definitely having an impact on bond prices and bond returns.
Well, maybe let's talk a little bit about the stock market because you hear the broader stock market is down. There are certainly different sectors in the market, and maybe touch a little bit on, is everything down, and is anything performing well?
Yeah. So I think when people think of the stock market, they kind of view it as monolithic, and they assume that everything must be down. But especially, and that's never the case. It is the case that in general, the types of sectors, whether it's like an energy sector, materials, they follow each other. So it's actually relatively rare to see something like this that we've seen this year. And that's why we wanted to highlight it so that you kind of understand the differences in the market. And what's pretty clear here is there has been a big divergence. It matters where you invest. Now, I would say you as an investor with WJ Interest and us, we own all these. So it's not like we do have managers who certainly pick different sectors, and certainly some of them have focused on energy, but other managers may focus more on maybe growth-oriented sector. But we're relying on a manager to do a lot of the kind of sector allocation. So what we're looking at here are the 11 main sectors in the S&P 500. So these are U.S. sectors. And then I added in my favorite from the ARK Innovation ETF. We've talked about ARK in the past. Kind of used it as the poster child for a lot of the excesses that we saw during COVID.
Maybe just touch on that a little bit. What is ARK?
Yeah, sure. So ARK is they call it, it's emerging technology. So it's going to be things like Tesla or Roku or Peloton or
electric vehicles.
It's like cool stuff. that the kids like today, right? It's like the cool stuff that everybody wants to own. And no doubt, some of these companies are going to be fabulous companies. The thing is, there's going to be a lot of them that don't make it. So Biotech is another example. So they're very speculative companies. The fund, which we've highlighted in the past, was up, I think, 50% a year up until about a year ago. It's down about 65, well, I mean, basically it's down 55% this year, but it's down like 70% from the high. Most of the companies that they own don't make money. So it was definitely an area of speculation. The manager is fully committed to the funds. She now claims that returns are going to be much higher in the future, but we highlighted it because those areas of the market have been just destroyed. So a lot of the very speculative companies are literally down 70, 80, 90%. Whereas the market as a whole at this point is down 20. And there's been stuff that's done well. And I mean, it's pretty obvious from this chart. Energy has done spectacularly well this year. So energy is literally up almost 50%. That's this year. At the end of last year, it was up as well. So we're in an environment where the oil price increase, the Ukraine situation, the lack of drilling and exploration recently, discussions on climate change have all led to a situation where there's not enough supply of oil, and then post-COVID demand is going up. So the combination of the two have driven prices up dramatically, and it's been hugely positive for energy companies. Remember, once again, you own some energy companies. It happens to be a relatively small part of the market, but you do have exposure to that area. And then the other thing I'll just point out is the pink. So that's the technology area. That has been the best area to be over the last 10 years. It hasn't quite suffered the most, but it has definitely struggled. So we've seen a rotation out of the kind of hot, cool, sexy stuff into the more mundane, industrial, energy, that kind of thing. And our managers have captured that. In addition, as we've discussed in the past, we have a weighting more towards value-oriented stocks, which happens to be kind of the stuff to the left and away from the stuff to the right. So that's been beneficial for portfolios also this year. So interesting, really dispersion between sectors that's maybe not quite as typical as what you might see in a downturn.
And I guess kind of a segue from that is, let's talk a little bit about inflation, because that's definitely top of mind. There's a big tie in between inflation, bonds, interest rates, obviously the stock market as well, but maybe touch a little bit on inflation, kind of where we are now, what the Fed's doing, how that's impacting bonds.
Yeah, Brendan, you want to talk about that a little bit? So I'm just going to pull up a chart where we show a couple series, and then Brandon can kind of highlight, but we're showing two things here. We're showing the blue line, that's inflation, so consumer price index. Just to give you a sense, over the last 100 years, inflation's been about 3%. Over the past 20 or 30 years, probably more like 2%. Today, it's currently around 8.5%. Okay, so you can see the dramatic increase recently. You have to go back to the early 80s. Many of you remember the early 70s and 80s, there was a huge inflation problem. Inflation got up to 15%. And then the other series that we're showing here is the 10-year Treasury Bond. So when you buy a 10-year Treasury Bond, the idea is you want to, first of all, try to protect yourself against inflation, right? So you're going to demand a higher and higher yield the more you think inflation is going to be higher in the future. And we can see that. They tend to follow each other. It's not exact, but it's relatively close. So when we talk about terrible returns on bonds, one of the reasons is you can see this huge increase in interest rates at the end. It doesn't appear huge when you look at the past, but in terms of percentage terms, I can show you it's pretty large. So let's talk a little bit about inflation, Brendan. Why is inflation so high? Like, what is the issue?
Yeah, so I mean, I think that's the most important part. It's a huge debate, I think, in politics around the world. Is first off, why is inflation where it's at? So it is at 8.5% year-over-year change in the CPI in March, and then in April it did come down just a little bit to 8.3, but it didn't come down as much as people expected. And so, the debate is, how long is inflation going to stay high? Is it going to continue coming down from there? Have we seen the peak? And a lot of what's going to influence, I think, your opinion of that is why we had inflation in the first place. And there's a lot of things that go into why inflation is created, but the main, simple explanation for inflation is just supply and demand, right? So if there's too much demand and not enough supply, inflation goes up and vice versa. So number one, on the supply side. So whenever we first, got introduced to COVID and there were shutdowns around the world, there were factories shut down around the world, people quit spending money on things that they used to spend money on, like going out to eat and so forth, and started spending more money on goods that they could, say order on Amazon or use at home. And so there's this huge shift where there isn't enough supply being created, but there are more people wanting things that they didn't used to want. So this demand's going up, supply is staying flat. And further fueling that are things like steady checks. So if you remember the stimulus checks in 2020, we had all kinds of stimulus checks and unemployment insurance to help people get through all the shutdowns. In addition, in 2021, we had more $1,400 stimulus checks that are going straight into people's wallet. And this is something that really the government has never done before, ours hasn't, putting money directly into people's pockets. And obviously it has the intended effect of getting people to spend that money on more stuff. So we have two things happening at the same time. We have factories being shut down and all of a sudden reopened. At the same point, we have people with more money in their pockets with a really high propensity to spend that money on physical goods. And that has caused this kind of huge inflation spike that you see on the far right of the chart over there. So based on that, I think we can kind of have the discussion now is, how much of that inflation is from government spending and how much do you think government spending is going to persist from here? On the other hand, how long is it going to take for supply chains to get back to normal? I'm sure you guys have heard about the semiconductor, supply chain crisis for over a couple of years now, or over a year now. When is that going to get better? And when are things going to return, quote unquote, to a more normal level?
Yep, and you could still see those huge. China's shut down again, basically completely. I think they're finally announced today they may be slightly reopening, but people can't leave their house. There's not enough workers to unload ships. So all of the supply chain issues that are, as a result of COVID, are going to take some time to go away. If you recall, the Fed initially called inflation transitory, and we talked about it at one of our luncheons. Ultimately, all transitory means it's not permanent, so we can agree it was transitory, but I think their idea was it's resulting from supply issues, and those will be worked out relatively quickly, and they just have not been. Right?
Well, there's a lot of debate on transitory, right? Like, what does transitory even mean? And I think that was one of the big issues is for people that say they feel like inflation is going to be transitory, and I would kind of put myself in that camp. Do you think inflation is going to be an issue for 6 months and then just be gone and we'll go back to normal? Or do you think maybe it takes a few years, it hurts a little bit, and then we go back to normal? Those are two very different things. And on the other hand, it could be wrong altogether and you have inflation for a decade, so it's hard enough to know whether inflation is going to be transitory or not. We can't even really agree on what transitory is. It's going to be months or years, and at what level,
And I think there's different components or different pieces that tie into that transitory versus not, right? There's inflation and it's across the broader basket that makes up inflation, but there's certain components that are going to be just more sticky and some that are truly this transitory.
Well, one of the things that you have to worry about inflation, I think this was a big problem back in the early 80s, was this sort of self-fulfilling prophecy is that people faced with inflation will tend to think they buy now because prices are going to be higher in the future. And when that kind of gets set in motion, it can lead to higher and higher inflation. I'm not sure we have that yet, but it's something to really watch because it tends to propagate itself. And I can remember back in the early 80s when it did, when inflation got up to 17, 18%. People were talking about the barter system. They were talking about things are going to go up forever. I'm going to buy. And so it tends to feed on itself. And we have to be, it's something we have to watch for. And that if it starts self-fulfilling, then it can go on for a long time.
Completely agree. I think the Fed worries a lot about that. I think we're going to talk about the Fed and their reaction to it, but they worry about that, and I think they feel like they need to be aggressive to try to ward that off, that kind of self-fulfilling aspect of it. I did want to show you, just going back to bonds, because as I mentioned, this is like the worst return we've seen in bonds in many, many years. This chart goes all the way back to 1970. So basically what I'm doing is I'm taking the bond yield, which say today is like 2.9% on a 10-year. So that's the interest rate that you earn, the coupon rate that you earn. And I'm comparing it to a year ago. And so if a year ago, say it's 3 now, just simple math, if a year ago was 1.5%, then it's doubled, it's up 100%. Okay. That's all this chart does over the past 40, 50 years, is we just compare where the yield is today to where it was before. The higher this number, the worse it is for bonds. So the more bonds are going to drop in value. So I put the bad on there to show you that anytime it's above 0, then over that past year, the value of bonds have dropped. It can go the other way too. And we can see that just as recently as 2020, bond returns were fabulous because interest rates went from like 2.5 at the high down to 0.5. Now, what they've done recently is gone from like 0.5 back up to 3. And you can see the dramatic increase, 160% at one point. And that's the reason bond returns have been so poor, is that the value of those bonds has dropped generally over about 10%. But remember though, the fact that bond returns are down now actually is a positive for bond investors longer term. And this is really important because, and we've talked about this in the past, we've talked about poor bond returns, but the thing is right now, our bond portfolio yields about 4%. Okay, and it's generally a pretty low risk bond portfolio. I can buy you a 10-year Treasury bond, which pays you 3%. If you want to take more risk, you can buy bonds on more risky companies that pay about 8%. That's more than double what we were seeing just about a year ago. So in addition, then, if I tell you that if you can get 3, 4, 5% from bonds and you see stocks declining, it starts to provide some competition for the stock market that maybe wasn't there before. There was a long discussion, we wrote about it, it's TINA, there is no alternative, and the argument was stocks are going up because no one wants to own bonds. Well, whatever the reverse of TINA is maybe what we're seeing now. Maybe we're seeing a transition into bonds. Just as another brief aside, historically, WGH, we bought some individual municipal bonds for clients. So with Bill's engineering background, Bill understands municipal bonds, say on Sienna or Lids or whatever, very well. And during 2008, some of you still own these, we were able to get a 10-year municipal bond, say on Cinco Ranch, that paid 5%, tax-free. That's a pretty darn attractive bond. At the bottom of the market, it was more like 1.5. We're starting to see yields get above like 3, 3.5. So once again, it creates an opportunity that was not there. It's painful to get there, but it opens up the kind of spectrum of opportunity in terms of bond investing, which is a good thing. Once again, it's painful to get there, but it basically increases future returns on bonds in some cases pretty dramatically. And then one final thing I'll mention, it matters what types of bonds that you own. Okay, so in our portfolios, we own a lot of shorter term maturity bonds. Those bonds aren't down near 10%. Some of them are down 1 or 2%. We don't own a lot of longer maturity bonds. And consequently, portfolios on the bond side, at least, have done much better than kind of the 10% losses because of the shorter maturity. We position that way simply because yields were basically at all-time lows, and the likelihood that they would go down more seemed a lot less than the likelihood that they might go up a lot. And that's subsequently happened. So that's helped our portfolios versus benchmarks. And I think we do get a lot of questions about bonds, no doubt. I'm like, why do I own them? What's the purpose if they're going to fall the same amount of stocks? Just remember, not all bonds are the same. And most of the bonds, which we can show you if you're interested, bond funds that we own aren't down near what say the 10% benchmark, let's say, is that tends to be a longer maturity bond. So it's been a really rough year. It may be the case, interestingly, that bonds maybe have peaked. We don't know for sure. as I said, the bond market, if you're a bond investor, you're just trying to judge what future inflation is. If you think it's not going to go a lot higher from here, and yields may start to come down, and we'll talk about actually a Treasury place to get to that.
And let's touch again on kind of inflation too. And we hear this in the media: soft landing versus hard landing. What does that mean? What's the risk of a recession? And what's the Fed doing about it? And what's our predicted likelihood?
Yeah. So I guess just to start with, let's just review kind of what the Fed's mandate is. And they have a dual mandate. One is to keep inflation, I say low. I don't know if that's actually is it low. It's not zero, but to keep inflation low. The other is full employment. And then the Fed's mind, those work against each other, right? Like if they're fighting inflation, then employment may go up and vice versa. So obviously, if inflation at 8.5%, they're not meeting their mandate. The idea behind the Fed is it's apolitical. It's separate from the elected government, although Jerome Powell is appointed by Biden, by the president. So I don't think they're completely segregated from political influence. Inflation's terrible for current politicians. I mean, when you go fill up your car, whether there's a sticker on there that says, I did this, people blame the president. He also gets credit when things are good. That's just the way it works. So there's a lot of pressure on the Fed to bring inflation down. So what can the Fed do? They really don't have that many tools. And we've seen them use them a lot over the past 10 years or so. You know, they can change interest rates, and that's their primary tool. When they change interest rates, they change the Fed funds rate, which is essentially kind of an interbank lending rate, but it's a very short maturity bonds. They don't touch 10-year bonds or 5-year bonds, 20-year bonds, except they do when they do quantitative easing. Okay, so quantitative easing is essentially printing money and buying bonds. So both those have influences on interest rates, but the primary thing that they do is influence the cost of money, which is interest rates. So they can't do anything about supply chain issues. They can't do anything about Chinese lockdowns. They couldn't do anything about US lockdowns. They just don't control any of that. They don't influence it, but they do influence interest rates. And so historically, at least, one of the ways that they've fought inflation is to increase interest rates, which slows demand. And a simple way to think about this is if you were going to buy a house about a year ago, you could have gotten a mortgage for 2.5%, which would mean if you looked at your salary and what the house cost and you looked at the monthly payment, let's just say you were stretching to afford it. That same mortgage is now twice that, 5.5%, which means that the affordability of housing has gone up. Now, in addition, or it's gone down. In addition, of course, the prices are up too, but the key is they impacted the price of that house by changing interest rates. And so the idea is that's going to slow demand for housing. We just saw it this morning. The number was way below expectations for housing starts. Was that starts or sales? New home sales were way down from what people expected, and there's no doubt that interest rates influence that. I'll just point out that Brandon's wife works for a mortgage company. They're doing layoffs now, right? I mean, they're to the point now where the demand for mortgages is down. And then anecdotally, you mentioned it the other day, we have a title company next to us. For a while, we couldn't even get a parking spot. You may have experienced that as a client. It's pretty wide open now. Definitely the business has changed. So the Fed does have an influence. And the influence is generally like, okay, we'll slow the economy, right? And when we slow the economy, that means that demand goes down, and that means that prices would go down, and that means they impact inflation. And since they don't believe inflation is transitory, that is what they're embarking on. So we could talk more about it. I did want to show you this chart. So they have raised rates twice now. Like this is just starting to 1%. What this chart shows is, I want you to focus on the dark blue line. That's the market's expected interest rate on short-term money over the next 3 or 4 years. So that's what the market expects. So what the first day is actually 6/13. The Fed meets at the beginning of June, and the expectation by the market is they're going to raise 50 basis points more, 0.5% more, so it'll be at 1.5. But look what happens over the subsequent quarters and year. They actually raise rates to 3%. So what does that mean? Well, that means, first of all, I guess from a positive perspective, your money market rates are going to go up. It's harder to tell what that means for longer term rates like mortgage rates, 10-year yields, or that kind of thing, because maybe since the market already is anticipating this, rates have already gone up a lot, right? Which we don't know for sure. We also don't know, and this is what that huge wide cone is. So like somebody here in the office was making a joke about this, like that's like the hurricane cone, right? You don't really know where it's going to end up. You just kind of have a sense. So it could be higher, it could be lower. But the point is, like, we don't know where it's going to end up, and where it ends up is going to impact the overall economy. It's going to impact overall inflation. And guess what? It's going to impact the stock market and the bond markets. So kind of what we're seeing today is the Fed is committed now to fighting inflation. They don't want to take hold, as Bill mentioned, like we got to fight it. They can't really back off now and say, oh, it's not a big deal. They have to fight it. And they may go too far, and they may raise rates too much, and it may slow the economy too much, and we may go into a recession. And in a recession, stocks don't typically fall just 10 or 20%. They fall more than that, right? And every day, market participants are trying to judge how far the Fed goes and whether that pushes us into a recession or not. And that's why you're seeing a lot of the volatility, despite the fact that the economy right now is actually pretty good, right? Like most people who want jobs have them. There's a bunch of job openings. House prices are up. Maybe recently, I was going to say companies are earning a lot of money. Maybe recently we've seen some indications that things are slowing down a bit, but the economy is relatively good. So, but remember, markets don't care about today or what's happened. They care about the future. They're trying to judge how much money Home Depot is going to make in the next 6 months or a year, not how good it's been for the past year.
Well, if you think back, just as once again thinking back to inflation in the early 80s, of course we were talking then about 18 or 19% inflation. You could buy mud bonds back then. Everybody understands mud bonds in Houston. You could buy them 10% tax free, and everybody said, "Boy, that's really a bargain." Except if inflation is 18. Now, if we see inflation continue, if we're at 8% now, if we see this 9%, it goes to 10, then I think you're going to see the Fed will have no choice but to really raise interest rates very high. If you think back in the 80s, early 80s, Volcker came in, who was Fed chairman then, and of course increased interest rates till it drove the economy into a recession. There was no soft landing. They almost couldn't be. They were so high that the Fed had to be extremely active. I don't think we see that now, but it just depends a lot on, as Brandon said earlier, on the supply chain situation and getting more goods to the market. It's really interesting going in a store today, and everybody's probably done it. There are a lot of empty shelves still. I mean, it's kind of amazing. I mean, there's a lot of stuff in there, but not like it used to be. There's just things that aren't there. Baby formula, I guess, is a great example. So we've got to get through this supply. And I don't know if anybody has the answer to that. There's too many moving parts, but if that will start to unwind, and if we see peak inflation now, I think it'll come out fine. Yeah. But it could continue, and we'll get in a spiral where they've got to drive the economy into a recession.
I kind of think you've got three scenarios. You've got like, hey, the inflation's just out of control, and we really have to do something. Or, I mean, inflation just for some reason collapses because of supply chain or whatever, and they can back off. And maybe that's more of a kind of, I guess, mention like a soft landing. Like that would be like the ideal situation. Would be good for stocks. Maybe they don't decline anymore, and they come back from here. Well, that scenario.
Yeah, I mean, that was kind of what Jonathan was asking originally, is like, what's a soft landing? What's a hard landing? The Fed has many times tried to inspire confidence that they think that they can manage a soft landing, which means they raise rates, they kind of wrangle inflation into control, but they don't slow the economy so much that it's destructive, right? They slow the economy, but people right now, like Jared said, can get jobs and wage growth is okay, and maybe we can withstand the raising rates long enough for inflation to come down, and then we kind of go back to normal, right? Normal being 2 to 3% inflation. Now, what they hope doesn't happen, and is definitely a possibility, is the hard landing situation where they overdo it and they raise rates too much, and it basically slams us into a recession, something that we're not prepared for now. and you end up, you know, trading one problem for the other. Right now, we're trading maybe too much growth and too much inflation for now a deep recession where people are now unemployed and demand's way down, and maybe even have deflation in a period like that, right? So that would be the hard landing scenario. The Fed is telling us they think they can navigate it without that, but only so much of that's in their control. So you know, that's the thing we gotta kind of wait and see.
I mean, if you look at history, it doesn't really support the soft landing scenario. Typically, the Fed has gone too far. And a lot of reasons for that. One is like, it's the economy, right? It's not like trying to pour a drink or something. It's very complicated. There's a lot of influences. There's a little feedback. There's all kinds of stuff that goes on that you have literally no control over. I mean, Ukraine, Putin, whatever. There's so many. In addition, when they raise rates, typically they say it takes like a year or two for it to have an impact. So when you do something and then you have to wait a year or two, well, you got to make another decision like 3 months later. You don't really know what the first decision what it
right.
made.
They're raising rates every 3 months.
Exactly.
They don't know what the impact of the last raise was.
They don't. In fact, Bostic, one of the Fed governors, the first person I heard say this, and I don't think these guys don't randomly say stuff. They talk about it in a message. He said, well, maybe in September we can stand back and wait. Okay. That's the market generally would feel good about that because that would mean they were done. But on the other hand, are they really committed to fighting inflation, which goes back to your problem? So they're really kind of stuck here. They're in a difficult situation, which just makes the soft landing scenario, you know, more unlikely.
There's one more piece to that too. It's another one of, I would say, the Fed's tools is guidance.
Yes.
Is the Fed is very public and very vocal about what they're trying to do and how they're going to do it. And they try to kind of lay out a timeline that's not going to surprise too many people. And what they're hoping is that in part, the market does some of their job for them, right? So you think about Treasury rates going from, you know, 1.5% to 3%. The Fed didn't do that. The market has done that already. Or mortgage rates going from 2.5 to 5, 5.5. That's not necessarily a Fed thing. That's the market anticipating that the Fed's going to be selling municipal bond, or not municipal, mortgage-backed securities and things like that. So a lot of these moves get made in advance of what the Fed is going to do. And I think that's kind of a feature, not a bug. That's what the Fed wants. It's for the market to kind of do some of those moves for them. And maybe then they don't have to go as far as they initially said they were going to.
Yes, so I think that's why stocks are down 20%. Because the Fed said we're going to raise, and the market thinks we're going to raise to 3, right. And that may be fine. The question is that probably means a slowing of the economy, but how much, right? So if it slows a lot more than they anticipate, then stocks need to go down more. If it doesn't, then they could go back up, which is typical of anything. But it's very influenced by the Fed, and I agree that they want to signal that they don't want to surprise the markets.
Too, I mean, the opposite is true too. In March of 2020, when the market was down 30%. The Fed came out and said, we're going to do whatever it takes to keep this thing afloat. So they said, we're going to buy corporate bonds and all sorts of other securities, and we're going to print a bunch of money and blah, blah, blah. And basically that day, the market bottomed and went straight up from there. And the Fed never actually had to buy all those bonds they said they were going to buy.
Barely bought
so they maybe committed to, I can't even remember what the number is, trillions.
Yeah,
and maybe they actually deployed, you know, 10% of the money they committed to using. So that's a big tool.
I think it's reasonable to say also, so far at least, we have not seen the panic that we experienced in 2020. And that was maybe one of the reasons the Fed, and when we're talking about panic, we're talking about you know, like literally no trading going on between bond managers or you know, stocks falling 30–40% in an hour, things that would indicate that the kind of the wheels aren't turning the way they're supposed to turn. And the Fed gets worried about that kind of thing. The plumbing, I guess, of the financial markets. We've not seen that so far. And there's another measure called the VIX, which is not as high maybe as it's been historically. There's not been a panic. This is more of an orderly type sell-off. But that could change.
So given what we just talked about, and nobody really knows how successful the Fed will be, whether it's soft landing, hard landing. How does that then affect how we position?
So I think that's actually the next slide. And we did, you will notice that you'll see in your portfolio, and I had several clients ask me, which is good, like, hey, did you place trades? So if you ever wonder if we placed a trade, please send it to us. We typically do send out information kind of describing the trade, but it's not necessarily before or after. Plus, the trades that we place, we've been doing like over the last week or so, just to make it efficient in terms of the way that we do it. So look, I'd say first that the diversification, the way we entered this year, the way we position portfolios forever is recognizing that we're going to go through periods like this, and that generally not everything goes down that's in the portfolio. Especially if you look outside of just stocks and bonds. Most portfolios that we see, most portfolios that clients own are typically just like US stocks in general, maybe a lot of growth stocks and then maybe a few bonds. We've never approached investing that way. We think it's critical that you own stocks outside the US, but we also think it's critical that you own some stuff that's a little bit unique, alternatives, things that can go up, 20% in a year where stocks are down 20 and bonds are down 10. So whether that's going to be trend following strategy or reinsurance, we just always thought those things were important. Sometimes they look stupid, they don't make any sense. Like I just put my money in Google, but in this year that's helped a lot. And we're definitely not reducing that, right? We're going to maintain that broad diversification. We are adding some additional tail risk protection. These are strategies. We talked about tail risk protection. The idea is like, why do you buy, insurance on your home? You pay a little bit each year. If it burns down, they make you whole. If it doesn't, then you lose a little bit each year. Essentially, that's the types of strategies that we're talking here. We've talked about it past budget, but these are relatively new funds that we now have access to. We're comfortable placing money in. It doesn't seem like a bad time to be adding a little bit more protection. So you'll see these SPD and CYA. Oh, by the way, we're sending out a WJ notes to describe this in more detail. We did rebalance portfolios. So the second bullet is providing additional protection. The third bullet is saying, we don't really know. We know stocks are down 20%. And when stocks go down 20%, future returns go up, right? So the idea is we took some bonds and bought some additional stock. And we will continue that, even if the market falls again, we'll continue to rebalance. It's a way to capture the losses. We added some treasuries. I mentioned that we haven't seen like a real panic yet. When people panic, they tend to go to the safest thing they can buy, which happens to be treasuries. Treasuries that has not happened. So we're making a bit of a bet on interest rates not going up a lot more, but we added some additional treasuries to portfolios. And then the final thing we did, which we'll continue to do if opportunities present themselves, is we capture tax losses. So it's a tax loss swap. We sell one fund. So for example, there's a fund, the ticker is BSNIX, and we bought a fund called MUB. If you had a $10,000 loss, for example, in BSNIX, you now can claim that on your taxes. We go into the new fund, we wait 31 days, and then we can swap back to the fund we want to be in. The risk that you take by swapping into that new fund is very limited. They're somewhat similar investments, but you're able to capture that $10,000 tax loss, for example. So if you're interested in seeing the mechanics of that or how that looks in your portfolio, please let us know. We can show you the totals.
And for many that had large tax losses, unrealized tax losses, we've already taken those. So
we have, yeah. So anyway, those were the trades that we placed recently. We basically completed the trades yesterday. We'll be sending out a WG notes with a little more detail. Tax loss selling will continue for sure. Rebalancing will continue for sure. And then remember, underneath what you have are managers who can shift between stocks and bonds. They tend to actually be pretty conservative now. Plus, you have managers who can, they can actually bet on interest rates going up or down, like the trend following strategy. So there's managers, I guess, selection or managers' decisions that you don't necessarily see but are occurring in the background. And that's why we own these ones.
So on the fourth bullet point there, we're adding treasuries to protect in case of a panic. One question I often hear is, well, why wouldn't we add gold and silver?
Yeah.
And why don't we add those? What are some other things that we may be doing too?
Yeah, so I guess I'd answer that two ways. One is it's likely that you own gold and silver in your portfolio. So the trend following managed future strategies, assuming gold has been going up recently, they will own gold. If it's been going down, then we'll bet against it. So we typically think that commodities over time probably don't have like an upward bias. In general, it's a commodity, it's going to fluctuate, it's going to move up and down. And so our view is like for gold or silver, if it's generally not just going to go up over time, then we kind of want to trade it. And we want to trade it based on a non-emotional method, which is just kind of looking at past returns. In addition, a lot of the reasons that you might own gold are you're concerned about like a currency collapse or that kind of thing. Remember, the way we would buy gold is through a security which represents gold, which may not provide you the kind of protection you want. Like if you want it, maybe you want to buy gold coins and put it in your safe deposit box. And the final thing is, it's very difficult to say what the return on gold or silver or Bitcoin, for that example, or any of those types of investments are, because there's no cash flow associated with it. And because we've always been a little uncomfortable with investments that are impossible to value.
And I get this question often because, a lot of clients are getting those emails of essentially what I would call junk emails. Buy gold now, buy gold now. And they get them all the time. And so often what you'll see, I think, in a lot of these emails, because I've been forwarded many of these, is almost cherry picking of data. Cherry picking a chart that shows that gold has done well over this environment. Where if you just either fast forward or back up, maybe by a few years, that narrative completely changes. So a lot of that is just kind of data mining.
Totally right. And look, I would say, like, people have always thought gold would be a great inflation hedge. And it ain't done much in the last year or two. So I don't know if that narrative is actually even that true, right?
Well, when you get one that says, if gold returns to its all-time high, you will make 100%. Well, wait a minute. I can say that about anything. I can say that about stocks or bonds or anything. Those are sales pitches, and
we all fear mongering right now, especially trying to scare people, really.
Yeah. So one question that we often get as well is, and what most of you will hear from us and will likely always hear from us, is the market's selling off, everybody's panicking. Maybe they're the smart ones because they're getting out of the market and they're selling. You as my advisor is always telling me to stay invested. And, I think many clients kind of struggle with that. Well, why would I stay invested? Everybody else is panicking and getting out. I'll kind of answer that one a little bit with, one, it always depends on what your financial plan is, right? And how your portfolio is designed around that financial plan. And so for almost every client that we have, we maybe have a handful, less than a handful, that are 100% in the stock market. And those are typically going to be clients that have a much longer time horizon. They can sustain some volatility because they're adding money to their portfolio over time. And so that's a way of kind of dollar cost averaging in. But for the majority of our clients, you're going to be in a diversified portfolio. To Jared's chart earlier that we show at every single client luncheon that we have, the periodic table of investments that shows all the different types of asset classes you can invest in. You're never at the top, but you're also never, more importantly, at the bottom. And the short answer of it is we don't really know what the future holds, but we do know that diversification has proven to be an effective strategy. And we run those inside of the models that we use for your financial plans to determine what the sensitivity is on your actual portfolio. And with market drops, are you running the risk of running out of money? And for those that we've answered that question of no, stay invested, that is the reason why. The reason is that you can sustain those. When you decide to get out of the market, and first of all, let me back up a little bit. When clients ask the question of, should I get out of the market? I think that typically stems from just looking at the pure stock market, right? 100% stock market, you see S&P 500, you see the Dow listed on the 6 o'clock news. It's down so much, everybody's panicking. Well, just remember that our portfolios for every client that we have are designed to be diversified. But the other component is too, let's say you are invested 100% in the stock market. When you get out of the stock market, you're making 3 decisions at that point in time. You're making a decision that 1, that's the right time to get out. That 2, you're going to know when to get back in. And 3, that you're going to actually have the wherewithal to get back in when it's the right time. it's very unlikely that anybody's going to get all three of those exactly correct. And so we look at it from a longer term lens, especially when we're looking at your financial plans. And if you, for some reason, feel that your plans are jeopardized because of this recent sell-off here, give us a call. Let's have the conversation. Let's go through your not only portfolio, but your financial plan to hopefully give you that peace of mind that we have, because we're not panicking. We're doing things in the portfolio and have already done things in the portfolio that should protect you.
Right, I think that's right, It's unless you just can't stand the volatility, but at the point in time when the market's down 20%, you better have been positioned somewhat anticipating it, which is where we are. Yeah, it's too late at that point in a way. Why take those losses when in fact your portfolio is widely diversified? Anticipate some of that. In April of 2009, after the 2008 sell-off, really when the market bottomed, if you'd have looked at the headlines and what was going on in the world, you'd say, there's no way it's time to get back in the market. I mean, the market does what it's going to do, and nobody can predict it. Once in a while, somebody is right, and they become famous, and it's the last time they ever predict it. They can do it one time. It's like a clock being right twice, during the day. So we don't position and try and time the market. We're not smart enough. Nobody is longer. What we try and do is, if based on our views and what's going on, is stay diversified and don't get excited about buying ARC stocks, which we talked about before. If somebody wants to do that, we always tell people you can do that, or frankly, if it's not your retirement income, if it's not your portfolio, buy that or go to Vegas. I mean, you can have fun with money, but don't let it influence your portfolio. And we've been doing this for 26 years now, and we've had people get out, not very many. We've had people get out, and then a year later, after the market's up 50%, stays the time to get back in. Because that second decision you talked about is really tough. You just can't do it successfully.
Yeah, I think it's interesting. We talked about the Fed increasing rates and soft landings and everything. The market will figure all that out way before anyone else does. And so the market will start going up prior to the Fed being done raising rates, prior to, if we're even in a recession, coming out of the recession. And it's pretty amazing. And to try to think that you can outthink that or overcome it or whatever it is, takes a lot of hubris to believe that, but we don't. So we just have to recognize we don't know, what the future holds.
We do know if rates keep going up, and Jerry said it very well, that ultimately bonds are going to be in that. The old return of 5% on bonds kind of was the old yardstick. Bonds are going to become real attractive again. If you can get 5%, and if you can get 4 or 5% on tax-free bonds,
it's the same argument for stocks. When stocks go down, generally the return goes up in the future. So, what we've gone through this year has been somewhat painful, but it does mean we've been talking about low returns for a while, right? We didn't even show the chart, but look, stocks are still stocks are still up a lot over the past 3 or 4 years. So what we've sold off, we haven't given back a lot of those gains. Most clients' portfolios are still substantially ahead, and now returns look a little better going forward.
Yeah, I think that's an important thing. You said that before. Stock future return on stock look a little better than that.
And that's reflected in the Monte Carlo simulations that we run. It's reflected in clients' plans. We account for almost we run 1,000 scenarios. I think we just put this in the WJ notes. There's no question that there was a scenario that looked like this. There was one where portfolios were down 10% to start the year, starting right now. And does that mean that they failed in the end? No, it really doesn't have as much influence as you might think. But I think the key to that is please reach out. Definitely, I know we get client calls where like, well, in a panic mode, I'd rather kind of go through it kind of non-emotionally and have you come in now and we can talk about risk tolerance and portfolio positioning, meaning that if stocks continue to go down, maybe it's a good time to have a conversation now.
And for those of you that we've met with since January, you've heard it from us that we adjusted future expected returns in the model, in your plan, and we reduced the expectations at that point. Now, if the market falls further, it's likely we're going to shift that and adjust it and actually increase that expectations, like Bill just mentioned. And so those are the things that we were already preparing for and building into the model, because when the market's really high, the future expected return is lower. And that was embedded into the model for most.
I'll see if we have any questions.
Yeah, we've been answering them as we're going through. One question we often get in meetings is RMDs. So market's down. Should I take my RMDs now? Should I wait? What's the best way to kind of time that throughout the year?
Yeah.
And I'll say that for RMDs, typically we suggest that you wait towards the end of the year. You're going to hear from us around October, November, if you haven't taken already. Some clients are going to be taking it systematically throughout the year, whether it's on a month-by-month basis or just in a lump sum. But in most scenarios, we recommend waiting towards the end of the year to take your RMDs, for the fact that in most years, the market tends to be up. And so if you wait towards the end of the year, you could potentially allow your portfolio to continue to grow, whereas that RMD stays fixed for that particular year. Now, that's RMDs. The other is what you've heard us talk about. Many have heard us talk about is Roth conversions. And Roth conversions is simply taking money from a traditional IRA or 401k and converting it to a Roth. You've got to pay the taxes on it at that point in time. And usually the timing of that depends on, we're either going to say, hey, do that towards the end of the year for the fact that what your expected return is or expected income is, not return, expected income is for that particular year for tax reasons.
Yep.
But another time to consider it is when the market sells off. I don't know that we're necessarily at a point right now to implement that, but March of 2020 is a prime example of when we reached out to many clients that are in that situation to do that. And when the market was down 30%, let's say you have a portfolio that's $100,000, it's an IRA, it dropped 30%. Let's just assume that was 100% stocks. So now it's worth 70,000. Well, instead of converting 100,000 before and paying taxes on 100,000, you convert 70,000 and only pay taxes on the 70,000, and it's still invested in the exact same.
So we are going to be working on, one of the things we need from clients is their previous year tax return. And so we'll be reaching out to you in order to do the Roth conversion calculation. And at least if markets continue to fall, then we definitely might consider accelerating those moving forward. And it's just a good opportunity. I think last year for most clients, we did half of what we proposed because we didn't know if markets would continue up or down.
And one question too is, okay, well, Roth conversions, RMDs, can I take my RMD and just convert it into a Roth? And the answer is, I wish you could do that. Unfortunately, you can't.
We get that question every year, especially good people who get RMDs. They think, man, I think I can do this. No, the government's thought of that one, unfortunately.
Yes. Now, that being said, though, even if you are in RMD age, which right now the age is 72, that could potentially change in the future to 73 and eventually 74. But for now, it's 72. You can still convert above that amount. So if your RMD is say 10,000, but you have the capacity to convert a little more based on what bracket you're in, you could certainly do that above that RMD amount. And then one question we have here is explain basis points.
Oh, I'm sorry. I tried to say it both ways. So the basis point is 0.01%. It's obviously it's used in the industry, and I try to avoid it. But internally, we kind of talk that way. So 100 basis points is 1%. So it's 0.01%. I think I said 50 basis points or 0.5. I don't actually know the origin of that. I think you motivated me to look it up, but I apologize.
But a great question. Yeah. Just a fancy way of saying interest. Yeah. So don't think we have any other questions here. I don't know from you guys if there's anything else.
No, I think definitely we're available. I think that's the key during these kind of rough times. We've always kind of prided ourselves on making sure that we do these conference calls and we're available on the phone. We definitely don't want to hide. These are the times I think when we can honestly provide the most value. Stocks are going up every day. We don't hear from clients, and that's fine. And we're still paying attention, but we're definitely paying attention now, and we're available. And And if you want to reach out to us, please do.
All right. So thank y'all. Appreciate the time.